Let's talk to Ryan Littlestone. He is a trader and analyst at ForexFlow.live. Very good morning to you, Ryan.
Good morning, Nick.
Right, two thought-provoking slides for us to review. Let's kick off with the first one. We've got a weekly chart of the euro against the US dollar. This looks quite bearish to me. Are you thinking the same
very bearish
thing?
indeed. It's a difficult one at the moment. We're seeing a lot of this. Obviously, this is emerging market FX moves out of these currencies into the dollar. That's coming from geopolitical worries with Trump and trade, and also obviously in Turkey with the pasta issue, and it's become a big snowball that's happened. And what that's doing now is obviously last week we saw a story that European banks, their exposure to Turkey could be fairly large. So that hit the euro, which had been pretty range bound, sort of 115, 118. And that's tipped it below this 115 area, which is a pretty sizable area. And we're struggling to recover that at the moment. We've found the low around about the 200 weekly MA, down in the 1370 odd area.
Right.
But we're struggling to bounce, and we try to bounce into 1400 today, and that's failed. I'm potentially a seller into 115, depending on what the news is, but it's looking very weak for the euro at the moment.
Right. Now, if I looked at a sort of textbook and this term, the head and shoulders formation, okay, I would look at a pretty sort of classical head and shoulders here, wouldn't I? I.e. a bearish looking chart.
Yeah, I mean, it's a bearish looking chart, which way you look at it. Whatever indicators your head and shoulders, I'm not one personally for head and shoulders patterns. But you can't ignore it. As I said, we've been talking about the euro dollar for a long time with you and me. And, I was a buyer all through last year, as you know.
Yeah.
I turned neutral into this year. And here we are. It's progressively bearish. And as I say, this break of 115 is potentially a big break. But where it stops is anyone's guess, down towards a sort of 113, 112. And that's the sort of area where I may be inclined to start picking it up for a longer term. But, at the moment, right now, this part of the year, central banks are pretty much out of the game. We know what the Fed's doing. The Bank of England's hiked. We know what they're doing. They're not likely to hike until next year. The ECB, we pretty much know what they're doing. So there's no real central bank expectation. The only one really is the Bank of Japan.
Yeah.
And we've been touting that since the beginning of the year that they could be the next big bank to start really shifting on their policy, and we're seeing some signs of it. But by and large, when you remove a big chunk of what the market trades and that central bank expectations, then it drags a bit of liquidity out of the market. We're still in a bit of summer trading, but that's gradually picking up. But it's the market needs a bone to chew on, and the bone is all this emerging market stuff, and we're seeing this weakness in pairs like the Brazilian real, Argentina, Mexico, as we're going to talk about, Turkey, India, you name it, and the dollar's being bought. But what we're finding, and something my colleague brought up, is that it's not a case of so much that everyone's piling into the dollar because they love the dollar. It's because they're getting out of everything else. And when investors get spooked, or they want to run to safety, they look around the globe, they see where the best yield is, or the safest yield is, and at the moment that is the US.
Yeah.
And so that's where people are going.
Understood. Okay, well, let's move on to a second slide. This is the US dollar against the Mexican currency, a 4-hour chart. Why on earth have you picked this one as a matter of interest?
I've picked it because I'm trading it at the moment.
Okay.
I've shorted it back in June. A load of us in our trading room, we got together to look at this pair because we had the elections coming up. We've got the NAFTA deal obviously still in play. And we thought it was a good short when it was up at the 20s, 21s. So I shorted it back in June, and I'm still holding shorts. I reloaded the other day, just under 19. It's being hit with all the rest of the emerging market and the LATAM currency moves at the moment, but we've still got NAFTA ongoing, and they seem to be pretty close to a deal, and that's going to be very positive for the Mexican dollar. And again, it's another currency where investors may not flee this currency as much as they will others. So hopefully this week we'll get some more news on NAFTA, and that'll give me a nice short there. But again, it's playing well with the technicals, as you can see from the chart. It hit that fib level there, held it pretty solidly, pretty much on the
Yeah.
button. And from a technical standpoint, that's exactly what you want to see, and that's exactly what you want to trade.
And in terms of the peso, is this fairly liquid?
Yeah, it's pretty liquid. Obviously, a huge trading partner to the US and indeed Canada. And yeah, you know, and the other side of the coin is it's got a good carry as well, so you can sit in a short and earn money even if you're offside. So that's also something to bear in mind if you're trading these currencies, is to make sure you're the right side of the carry, because
Yeah.
you get hammered if you're on the other side.
Okay, well, good luck with your shorts.
Lovely, cheers.
On that note, Ryan, as always, thank you very much for your time.
Cheers, Nick.